Hi, thanks for joining. I'm Karen Zisko with Neighborhood Loans. Today I want to cover mortgage basics for realtors and first-time homebuyers. My goal with today's video is to help buyers get approved faster and be able to close stronger, also to understand lending basics and for realtors to get more offers accepted. So with today's agenda, what we're going to cover is how DTIs are calculated, loan program overviews, cash to close, what are DTI ratios, show some examples along with some credit information, some assistance programs, and common mistakes that delay the approval process. So let's start with the loan program snapshot. Let's talk about loans. There's an FHA loan, conventional, VA, USDA, or non-QM, which those loans are more of the creative options like bank statements, 1099, investors, and unique income situations. So let's talk about FHA loans first and some of the positives and some of the negatives about them. So a positive, it's 3.5% down. They are for owner-occupant borrowers. They typically can handle lower credit score and have the flexibility. You can go down to a 500 credit score with 10% down. Most will lend at 3.5% if your score's at 580 or higher. So there is an upfront mortgage insurance premium. It is not paid out of pocket, though. It is rolled into the mortgage. And a benefit, if somebody is in Chapter 13, you can buy while in 13 as long as you've made 12 months of payments on time. If the bankruptcy was discharged or dismissed, it is a 2-year waiting period. So it's great for first-time homebuyers and credit rebuild clients. And it allows to go up to a higher debt-to-income ratio. Now, one downside, if somebody wants to buy a condo, the condo complex does need to be approved on the FHA approved list. If it is not already approved and the HOA agrees to supply the paperwork, the lender can do what's called a spot approval or help them to get approved through the FHA system. Loan limits for 2026. Up to 4 units, you could go up to a little over $1 million. 3 units, $837, 2 units, $693, and 1 unit up to $541. So it's a great flexible option for most borrowers. So one thing that FHA does have for 3 and 4 unit properties is a self-sufficiency rule. What is self-sufficiency? The rental income of the property needs to cover the mortgage payment. So how do we calculate that? We take 75% of the market rent for all the units. That number needs to be higher than the principal, interest, taxes, and insurance of the property. And we are using the appraiser's market schedule from the appraisal to determine what the rent in the area is. And the reason why we're using 75% is because they do calculate in a vacancy factor. Now, if you have something under contract and it does not meet self-sufficiency with an FHA loan, you will not be able to close. You will either need to put more money down or lower the price of the property. So 3 and 4 units also require reserves, which is extra money that you have in savings in the event something were to happen or a property were to, or a unit would become vacant. So you do have to have 3 months of payments of principal, interest, taxes, and insurance in the bank somewhere. And it cannot be a gift. It needs to be your own funds. So let's look at an example of this self-sufficiency rule. So if the mortgage payment on the property, let's say, is $4,200, market rent for each of the 4 units is $1,500 per unit, then you're getting $6,000. 75% of that is $4,500. So you are, in fact, meeting self-sufficiency. So this one is good to go. Now, if the payment, let's say, was $4,700, it would not work. So it's very important when you're shopping for a property to house hack that not only does your lender know what the rents are in the area, but also that you ask your real estate agent. And if you're an agent, make sure that you're looking at the rents in the area prior to showing any of the properties. Now let's talk about conventional loans. Conventional loans, you can go down as low as 3%. A lot of people will put 5% down. It is a misconception that you need to put 20% down. So the lower the mortgage insurance is, or I'm sorry, the higher your credit is, the lower the mortgage insurance will be. And there is no upfront mortgage insurance like FHA where it rolls it into the loan. Conventional does not have upfront mortgage insurance. It's great for higher credit borrowers. It does have a little bit lower debt to income ratio requirements too. Loan limits, you can go a little bit higher. 1 unit's up to 832, where FHA is at 541. 2 units, 1,066,000. 3 units, 1.2, and 4 units, 1.6. And they do not have the self-sufficiency rule that FHA does. Now let's talk about the low down payment options. Home Ready and Home Possible. Home Ready is Fannie Mae's version. Home Possible is Freddie Mac's. So it's only 3% down. There are very flexible qualifications. They do gear towards lower income limits. And these loans are designed for moderate to low income borrowers. You need to make less than 80% of the average median income in the area. Now, one cool, unique thing is you can use boarder or rental income to help qualify. Co-borrowers are allowed even if they do not live in the home. They do have reduced mortgage insurance, and mortgage insurance can be removed once you get 20% equity. Unlike FHA, it will stay in the property unless you put 20% down. It is not just for first-time home buyers, which is a great added advantage. And it has to be for primary residence only. So this is a great option for borrowers with great credit but limited savings, or borrowers that don't want a lifetime of mortgage insurance. House hacking is possible. You can do 5% down. 3% of it needs to come from the borrower. And the rest can be a gift, down payment assistance, or a grant. VA loans. Thank you to all of our veterans who have served. Your veteran entitlement allows you to have 0 down. And realtors, if you're in a situation where a borrower comes to you with a VA loan, and sometimes some people will say, well, they don't have any stake in the game because they're not putting any money down. Remember, they put their lives on the line for us. So they did have some stake in the game. So it is no down payment, competitive interest rates. There is no mortgage insurance. It is for eligible veterans and active duty and their spouses. There are some situations where a spouse of a deceased veteran does qualify. Condos. If you're buying with a VA loan, a condo needs to be approved on the VA approved condo list. Here is the link to check if that complex is approved. Also, you can check your area and see what complexes are approved and then look for properties that way. USDA. Anyone that wants to buy in a rural area, USDA is a great option. It is also 0% down. There are income limits, so it does depend on the county that you're buying in. You will have to go to the USDA eligibility site to see what the income limit is in your area. Also, the property has to be an approved USDA area, and to search the USDA map, here is the link. Now, let's talk about non-QM loans. Non-QM loans are more creative loans that are designed for people that have either a lot of money or self-employed. Here are some of those options. And the bank statement loans can be 12 or 24 months. DSCR loan is an investment type loan where we are using the rent for the property to qualify for the loan. We are not looking at somebody's personal income or a debt to income ratio to qualify. A 1099 loan, we're using a percentage of the 1099. Same with the profit and loss. Asset depletion, we use a formula to determine if the amount of money that somebody has will cover the mortgage payment for a set period of time. No income verification, same for self-employed. We show money coming in, but we're using a percentage of that. Renovation loans. Renovation loans are a great loan, especially if you're looking at an area that may have some dated inventory or smaller homes and you need a larger home, but you want to live in that neighborhood. You can use a renovation loan. You can buy it, fix it, and it's one loan. We finance it all together. That loan covers the purchase plus the repairs, and it's great, like I said, for those fixer-uppers and outdated. Gives you instant equity because you're buying the home less than market value usually because it's dated or there's something wrong with it. You're putting less cash out of pocket because depending on what type of loan you're doing, you're financing the purchase plus the renovation. But remember, you're only putting the 3.5%, 3 or 5% down. You're not fronting that whole renovation in addition to the purchase of the house. So don't skip the ugly homes. Think of a renovation loan as opportunity to create equity. So when we talk about renovation loans, how many types of renovation loans are there? The first thing that everyone thinks of says 203K, but did you know there's actually a conventional home style loan that allows you to put 3.5% to 5% down? It does for a primary property. For a second home, it is 10% down. For an investment single family, so condo, townhome, single family, you're looking at 15% down. It allows you to do luxury and cosmetic upgrades. So, think of the pool, think of the sunroom, those type of additions. FHA 203K, again, that's for an owner occupant, is 3.5% down. And you can do up to 4-unit properties. So it's great for first-time home buyers, and it does allow major structural repairs. So you can repair the foundation. You can add on to a property. VA renovation for our veterans. There is a renovation option where you can get financing up to $75,000 for cosmetic repairs. So we just roll it into the loan like we do the other ones. So let's talk about debt to income ratio, because everyone that qualifies for a loan, except for the creative non-QMs, will hear the word, it's not within the ratios. What does that actually mean? Let's break down debt to income. So what we do is we look at all of your monthly debts and divide by your gross monthly income. Now, the debts that we're looking at, they are installment loans. So things like your car. We're looking at minimum monthly payments on your credit cards and any sort of mortgage. If you have student loans, if they're in deferment, we do have to calculate those as a future debt that may have to be paid. So each different loan has a different calculation. You could reach out to me for details if you have a specific question on that. Also, any sort of tax payment that you need to make, like let's say you're making payments to the IRS, child support needs to get included, alimony. So we need to know all the debts going into it. And what the debt to income ratio is used for is it's used to measure affordability and risk. Can somebody actually afford to make the monthly payments? And there are two ratios when it comes to debt to income ratio. The first is the housing ratio, and then the total debt to income ratio. So let's look at how those are calculated. So the housing ratio, or the front end ratio, is only the price or the payment on the house. So you're looking at principal, interest, taxes, insurance, and any HOA fees. And this is for the new property that you're getting. So, and then we're taking that total and dividing it by your gross monthly income. So if the payment, let's say, is $2,000 and you're making $6,000, your housing ratio is 33%. So now let's look at the back end ratio. What we're doing with the back end is we're taking the total from the front end of what the house payment was, principal, interest, taxes, association, and insurance, and all of those revolving debts, installment debts, mortgages, and monthly obligations, and we're adding those together, and then we're dividing by your gross income. So let's say you have a $2,000 mortgage payment. The rest of your debts are only $800, so you're at $2,800 divided by 6,000, you're at 47%. So when somebody looks at a debt to income ratio, that's what they're looking at. Now, let's see why and how that matters when it comes to a financing, the different loan programs and what the guidelines are for the programs. So FHA, you could go up to 47 on the front end and 56 on the back end. Now, of course, it is driven by credit history, and what the underwriting system will allow, but that's a good rough guideline of where your approval range will usually fall. Conventional, you're looking at 45 on the front end. With good credit, it can go a little bit higher. With low credit, you're kind of at 36 over 50. And of course, you need the underwriting system, automated underwriting system approval. That's what AUS stands for. VA does have flexible requirements, and the more residual or reserves or residual income, which is income that you're getting that's above and beyond what's used to qualify, and also savings helps. USDA is at 32 over 44. They have a very strict, hard and fast front end ratio. You cannot go over that. So let's look at income. So when we look at income, we are looking at it, are you hourly, salary, or commission? So you're one of those three. So let's look at a standard hourly commission. So we're looking at your hourly rate times your average hours worked times 52 divided by 12. That gives us your gross monthly income. Now, lenders are going to be the most conservative when it comes to income. So let's say you're working less hours than you should be working. It doesn't matter what you should be working. We're looking at what you actually are working. So let's look at an example here. So let's say somebody is consistently 40 hours, $25 an hour times 40 times 52 divided by 12. So you break that down and you're using $4,333 a month. And we are using this because we are looking at your pay stub and verifying that the day of the pay stub that we look at, we can run the numbers backwards and see your hours are at least 40 consistently or more. Now, why is this important? Let's say it's inconsistent, or you were working 40 hours when the lender qualified you, but then you had to take some time off then, or work got slow and they sent you home early, and now it becomes inconsistent hours. Then in that case, let's say you drop from 32 or 40 down to 32 in this scenario, the person's income dropped by about $867 a month. What that does is that actually will convert it so you no longer have that same income, which will throw that debt to income ratio off, and you may not qualify for that property. And now, instead of it being consistent and the lender being able to use your hourly rate, we have to average your last 2 years of income to show that consistency in income. So let's look at overtime and bonus income. So overtime and bonus income has to be consistent, and it has to be likely to continue. It cannot be like a one-time thing, like a sign-on bonus of $10,000 that you got just once. We're not going to be able to use that as qualifying income. You can use the assets to be able to help purchase the home, but we're not going to be able to add that to your income. So let's look at how it's calculated. We're going to look at the last 24 months of overtime. And how do we determine what those are? We're going to ask you for your last pay stub from the last 2 years along with year to date, because we have to show that you're still continuing to receive it, but we're looking back 24 months to average that, because we want to show that it's continuing, it's stable or increasing, and it's not declining. So let's look at an example. So for year number one, the person made 8,000. Year number two, 10. So what we're doing is we're looking at about $750 a month to qualify. So why accurate income matters? Because if you're providing the loan officer with inaccurate income to start with, you're not going to get an accurate approval. So if you overstate the amount of money that you make when you originally talk to a loan officer, they're going to calculate your approval based on too high of an income. If you tell them too little of income, then you're going to get an approval that may be less than what you were looking for. Things like Social Security income, any sort of child support, alimony, if you want to use it, you need to tell the loan officer it exists so they can qualify you with it. So if you talk to two lenders or realtors, if you have two approval letters from two different loan officers that have grossly different amounts, it's not that one loan officer is necessarily worse than the other. You want to find out why. Did they change the amount of income that a borrower told them? Did they forget about a job? What is the difference? So clean data is a clean approval. Garbage in, you get garbage out. So let's look at cash to close. What is the total of the cash to close? It's comprised of these three things: down payment, closing costs, prepaids, and escrows. So that equals your total funds needed to close. So let's look at a mortgage pre-approval. The lender is going to review the income, the credits, the money they have in the bank, and the total debts. From there, they're going to determine the maximum loan amount and establish an estimated monthly payment. So that payment is going to be based on today's rates, taxes, and insurance estimates for that property. So now here's where it kind of gets tricky when it comes to lending. Taxes vary widely depending on where you're buying. Sometimes the cities are a lot lower, sometimes the suburbs are. Sometimes the suburbs are way higher. And also the insurance. So at the time of pre-approval, a loan officer does not have any idea of what the taxes are or the insurance. So they're going to use an estimated number, along with interest rates. As we know, they change every day. So they're going to use whatever today's rates are to base that approval on. So when a loan officer issues a pre-approval, it's going to help the buyer shop with confidence and a realtor to present a strong offer with that approval letter. Prior to writing any offer, you want your loan officer to calculate what your payment is and your cash to close is before you write that offer, just to make sure that it's within the range that you were expecting and that you're okay with the payment and okay with the cash to close. So let's look at how your total payment is built. You're taking the principal, interest, taxes, insurance, and mortgage insurance. And all of those things, as we saw, count towards your debt to income ratio. And the lenders use that qualifying amount and your total housing payment to come up with that approval. So here are some key points for everyone. So approval is based on payment, not the purchase price. So when you say, I'm approved for a $350,000 loan, that's not the mindset that you want to go into that shopping experience with. You want to say, I'm approved on a pre-approval based on a payment of $3,200. So when looking at properties, you want to know the taxes, insurance, mortgage insurance, and the interest rate, because all of those items affect your qualification. So the higher the expense can be, then it can push your debt to income ratio over the limits. So let's see how that can happen. Let's look at a pre-approval. Sally is pre-approved with a purchase price of $341, interest rate at 6%, with taxes at $147 a month, homeowners insurance at $130, with a total payment of $25.19. So when you get your pre-approval letter in your hand, if your lender does not tell you, or agents, if the pre-approval does not tell you what are the taxes and what are the insurance that was used to calculate this approval, please ask them before going out and going house shopping, because what can happen next can be very heartbreaking. Let's say you look at a different property. The approval was based on the taxes at that very low amount, but now you're looking at a property at $341, which is your approval amount, right? But the taxes are $757. The insurance for that house actually comes in at $200. Your higher monthly payment and higher DTI, and your higher monthly payment and expenses, it may not fall within your DTI requirements. So let's look at that breakdown. You have your principal and interest at $2,090, taxes at $757, insurance at $200, mortgage insurance, let's say $149. Your total payment now is $3,197. Now that increased over $678. So do you think you qualify? Probably not. So your payment jumped up almost $700. It drastically increased your debt to income ratio, and it likely exceeded the program limits for what you were approved in. And buyers, you may no longer qualify. So not only have you wasted your time and the realtor's time, it's a lot of heartbreak. So the important lesson is it's not just the price that matters, it's the property taxes that can make or break the deal. High taxes can blow the DTI ratio right out of the water.